Could SpaceX ever trade at $1,000 a share? Before anyone gets carried away, the share count math makes this much more extreme than it sounds. After the IPO and the full underwriter option, SpaceX had roughly 7.46 billion Class A shares and 5.70 billion Class B shares outstanding on the prospectus basis. That is about 13.16 billion shares in total. Multiply that by $1,000, and the implied equity value is approximately $13.2 trillion before future dilution. It is also roughly 7.4 times the $135 IPO price. So this is not my price target, and it is not financial advice. It is a 5-part test. What would have to become true for the market even to debate that valuation? The answer is not simply more rocket launches. SpaceX would need to turn Starlink into a global utility, make Starship economics work, monetize ordinary phones, establish a serious AI business, and convert vertical integration into exceptional free cash flow. Here are the 5 reasons and the proof each one still needs. Reason 1 is Starlink. Because recurring connectivity revenue is already the clearest foundation beneath the SpaceX valuation. Associated Press reported that second quarter 2026 company revenue reached $7.8 billion, more than 90% above the prior year, while connectivity revenue increased 66% and Starlink subscribers doubled to 12 million. The final prospectus provides a useful earlier checkpoint. At the end of March, SpaceX reported 10.3 million Starlink subscribers across 164 countries, territories, and other markets, up about 105% from 5 million a year earlier. But average monthly revenue per subscriber fell from $86 to $66. That tension matters. Subscriber growth is powerful, but growth created by lower prices does not automatically support a $13 trillion company. The bull case requires Starlink to keep adding households while earning more from aviation, maritime, enterprise, government, priority data, and other premium services. For scale, 100 million service lines at an illustrative $50 per month would produce $60 billion of annual service revenue before equipment and premium products. 300 million lines would produce $180 billion. Those are not forecasts. They show why a global communications utility could become enormous, and why 12 million subscribers, impressive as that is, remains an early chapter. Reason 2 is Starship. Starlink can only become dramatically larger if SpaceX can add capacity faster and cheaper than demand grows. The prospectus says each planned V3 Starlink satellite is designed for 1 terabit per second of downlink capacity, and one Starship launch could deploy as many as 60 V3 satellites. SpaceX estimates that would place about 20 times more Starlink downlink capacity into orbit than one Falcon 9 launch. That is the important unit economics story, not spectacle, but cost per useful bit delivered. SpaceX has already invested more than $15 billion in Starship, and the vehicle is intended to make both stages fully and rapidly reusable. If it eventually flies often, returns reliably, and needs limited refurbishment, SpaceX could deploy broadband, mobile, lunar, and AI infrastructure on a scale that Falcon cannot economically match. But this reason is also the central technical risk. Rapid ship reuse and airline-like turnaround have not been demonstrated as a mature service. The prospectus itself warns that delays in Starship cadence, reuse, or capability could slow V3 satellites, mobile expansion, and orbital compute. So the bullish proof point is not one dramatic test. It is a repeatable sequence: payload delivery, controlled return, inspection, refurbishment, and reflight, measured in days rather than a long recovery campaign. If that curve bends, several SpaceX businesses accelerate at once. If it does not, the $1,000 case loses its most important multiplier. Reason 3 is satellite to mobile service. Traditional Starlink requires a terminal. Starlink Mobile is designed to reach ordinary phones, potentially expanding the addressable market from households and businesses to billions of connected devices. As of March 2026, SpaceX reported approximately 650 first-generation mobile satellites providing data, messaging, and over-the-top voice service to about 7.4 million monthly unique devices across roughly 30 countries. The company also reported partnerships with approximately 30 mobile network operators across 6 continents, covering an area home to about 1.9 billion people. Its commercial model can include a fixed payment or a fee for each mobile user, normally sold through the carrier as an add-on. This is strategically different from selling one dish to one household. SpaceX can become infrastructure inside another company's subscription relationship. The same network can support emergency communication, remote work, shipping, aviation, agriculture, logistics, and connected machines. The prospectus says more capable V2 mobile satellites are expected to begin deploying on Starship in 2027, with broadband data and Internet of Things connectivity as longer-term goals. But partnerships are not regulatory approval, and coverage is not the same as paid usage. Spectrum rights, handset support, interference rules, country-by-country licenses, capacity, and pricing will determine whether this becomes a premium utility or a useful niche. The proof investors need is rising mobile revenue per covered device, not merely a larger coverage map. Reason 4 is the most speculative and potentially the largest. AI. SpaceX acquired xAI in early 2026, bringing the Grok models, the X platform, terrestrial computing infrastructure, rockets, satellite manufacturing, and the Starlink network into one company. SpaceX argues that this combination could eventually support AI data centers in orbit, using abundant solar energy, satellite-scale manufacturing, and Starlink for global connectivity. Its prospectus says initial orbital AI compute satellites could begin deploying as early as 2028. The phrase "as early as" is essential. It is an ambition, not a guaranteed commercial date. Orbital computing must overcome launch cost, radiation, thermal management, hardware replacement, latency, networking, regulation, and the economics of competing with rapidly expanding terrestrial data centers. It also consumes extraordinary capital. Associated Press reported that infrastructure and research spending reached $18 billion in the second quarter, up from less than $3 billion a year earlier, while SpaceX still posted a quarterly loss. Yet the upside explains why investors may value SpaceX as more than a launch and internet company. If Grok produces durable software revenue and orbital infrastructure becomes technically and economically credible, the addressable market expands from communications into global computing. This reason deserves optionality value today, but a $13 trillion valuation would require revenue, customers, deployed capacity, and returns on capital, not renderings or distant deployment targets. Reason 5 is the integrated flywheel. Since 2023, SpaceX says its Falcon rockets have launched more than 80% of the world's mass to orbit each year, with a mission success rate above 99%. That launch position is not only an outside service, it supports SpaceX's own satellite network. The satellites generate recurring connectivity revenue. That revenue helps fund rockets, terminals, spectrum, factories, and software. X supplies global distribution and real-time information. AI can improve products across the system and create a new service layer. Few competitors control so many linked components. The financial evidence is mixed but important. In the first quarter of 2026, the connectivity segment generated approximately $1.19 billion of operating income. For all of 2025, that segment produced about $4.42 billion. At the consolidated level, however, SpaceX reported a first-quarter operating loss of roughly $1.94 billion, and Associated Press reported a second-quarter net loss of $541 million. Profitable connectivity is currently carrying very heavy investment elsewhere. The $1,000 thesis requires that investment to become a flywheel rather than a treadmill. Launch and satellite scale must lower unit costs. Premium connectivity must lift margins. AI spending must create saleable products. Capital expenditure must eventually produce free cash flow. Vertical integration can generate extraordinary operating leverage, but only after the numbers prove it. Now, bring those 5 reasons back to valuation. A $13.2 trillion equity value cannot be supported by a clever product story alone. It would require SpaceX to become an economic platform at a scale no public company has yet sustained. Here is a deliberately simple reality check. At 30 times mature annual net income, a $13.2 trillion valuation implies roughly $439 billion of yearly profit. At 40 times earnings, it still implies about $329 billion. If a mature SpaceX earned a 25% net margin, those profit levels would require roughly $1.3 to $1.8 trillion of annual revenue. This is not a discounted cash flow model, and it ignores debt, cash, dilution, taxes, timing, and changing market multiples. It is a scale detector. Against second-quarter revenue of $7.8 billion, the company would need decades of compounding compressed into an unusually successful period. That path might combine hundreds of millions of connectivity relationships, premium enterprise and government contracts, high-cadence launch, mobile service, AI subscriptions, compute infrastructure, and businesses that do not yet exist. A $1,000 share price is therefore not a normal bull case. It is an extreme success case in which several giant markets mature together, and the company preserves unusually high margins. Instead of watching the stock price, watch 5 operating numbers. First, Starlink subscriber growth together with average revenue per subscriber. A rising customer count with permanently falling ARPU can create revenue without creating the margins this valuation needs. Second, V3 capacity deployed per quarter and the share delivered by Starship. That will show whether the new rocket is changing network economics rather than simply generating headlines. Third, paid mobile engagement, monthly active devices, carrier revenue, and higher bandwidth service approvals. Coverage announcements are useful, but monetization is the proof. Fourth, AI revenue and deployed compute compared with capital spending. Investors need to see commercial output grow faster than the bill for infrastructure. Fifth, consolidated operating margin, free cash flow, and diluted share count. The IPO created a large cash position, but acquisitions, compensation, and future share issuance can change what one share represents. If these 5 measures improve together, the valuation conversation becomes more serious. If only subscribers and spending rise while ARPU, margins, and cash flow lag, the $1,000 headline remains storytelling. This scorecard also prevents double counting. Starship is valuable partly because it improves Starlink and mobile economics. Those benefits cannot be counted again as unrelated miracles. The risks are as large as the opportunity. Starship may take longer to reach dependable reuse, limiting V3, mobile, lunar, and orbital compute plans. Starlink growth may require lower prices, keeping ARPU under pressure. Spectrum and launch approvals can delay service even when the hardware works. Terrestrial fiber, mobile networks, competing constellations, and rapidly improving AI systems will not stand still. Heavy capital spending can consume cash for years, and high interest expense or additional debt can reduce equity value. Stock compensation, acquisitions, and new issuance can dilute each share. SpaceX also remains a controlled company, with unusually concentrated voting power and exposure to decisions across several ambitious businesses. Finally, valuation multiples can contract even when operations improve. A business can grow quickly while its stock disappoints if investors previously paid for even faster growth. These are not small footnotes. They are the reason the 5 reasons must be treated as tests rather than promises. The strongest version of the thesis requires technical execution, regulatory cooperation, disciplined capital allocation, customer adoption, pricing power, and time, all at once. So, could SpaceX reach $1,000 per share? Mathematically, yes. Fundamentally, it would require an outcome far beyond the current business. Starlink is the most credible pillar because subscriber and connectivity revenue growth are already visible. Starship is the critical multiplier because it could change the cost and capacity of everything placed in orbit. Satellite to mobile could turn ordinary phones into a much larger distribution network. AI and orbital compute provide enormous but highly speculative optionality. And vertical integration could eventually convert all 4 into exceptional margins and cash flow. But at approximately $13.2 trillion before future dilution, $1,000 per share should be framed as an extreme destination, not a near-term target. The serious investor question is not whether the chart can reach 4 digits. It is whether the 5-number scorecard keeps proving that SpaceX is becoming a global infrastructure and computing platform. Subscribe for the evidence, the risks, and every milestone that changes the valuation. This is SpaceXInvestor.